Steve, welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamoan, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions.
Janine. This podcast is brought to you by Real Approved Incorporated, a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode.
Steve, today we're starting off with a focus on the Canadian housing market, which, despite plunging interest rates, is unlikely to surge. According to Canadian Mortgage Professional magazine, the ongoing trade war with the United States is casting a shadow over the economic outlook, and that uncertainty is keeping potential buyers cautious.
Janine. That's right, Steve. Even though mortgage rates are slipping and could drop further, people are hesitant to jump back into the market. It's understandable, given that buying a home is such a significant financial decision. The uncertainty around the economy makes people think twice.
Steve, exactly, Janine. The Bank of Montreal's chief economist, Doug Porter, pointed out that while lower interest rates should theoretically boost the housing market, the expected weaker growth and employment markets are acting as a counterbalance. It's a challenging situation.
Janine, and it's not just about the numbers, Steve. The emotional aspect of buying a home during uncertain times can't be understated. People want to feel secure in their jobs and financial stability before making such a big investment.
Steve, true, Janine. The Bank of Canada has already cut its benchmark interest rate to 2.75%, marking the seventh consecutive reduction. But even with these cuts, the trade war's impact on employment could have significant spillover effects on the housing market. It's a balancing act between low rates and economic uncertainty.
Janine, and while housing is primarily a domestic industry, it isn't entirely immune to these broader economic challenges. There's hope that as the uncertainty fades, the lower interest rates will encourage more buyers to enter the market. But for now, it seems like a chilly spring for real estate.
Steve, indeed, Janine. The Bank of Canada remains committed to its 2% inflation target, even amidst the tariff war. There's a delicate balance to strike between inflation concerns and the need to support the economy with lower rates. It's a complex situation, and we'll have to watch how it develops over the coming months. Steve, let's start by discussing the current state of Canada's mortgage market as it braces for significant changes. According to a recent report from Equifax, the market is experiencing a rebound, with new originations up 39% year over year. However, much of this growth is tied to renewals and refinancing, which account for more than half of these new originations.
Janine, that's a significant figure, Steve. It shows that while there is activity in the market, it's largely driven by existing homeowners looking to renew or refinance their mortgages. This might not indicate a true expansion of new buyers entering the market.
Steve, exactly, Janine. And with more than 1 million fixed-rate mortgages set to renew in 2025, there is additional pressure on the market. Equifax reports that mortgage defaults have been climbing, with overall balances past due rising by 43% year over year. This is a concerning trend as it exceeds pre-pandemic levels.
Janine, it's definitely worrisome, Steve. Many homeowners are facing increased monthly payments, especially those in Ontario and British Columbia. In these provinces, over 10% of renewals have seen monthly payments increase by $500 or more. That kind of jump can significantly strain household budgets.
Steve, with interest rates having been on the rise, it's no surprise that these payment increases are causing some financial distress. While lower interest rates could provide relief, Equifax cautions that the full impact of these lower rates may not be felt until mid-2025.
Janine, in the meantime, many homeowners will experience payment shocks, especially those who took on fixed-rate mortgages back in 2020. They're transitioning from historically low rates to much higher ones now, which can be quite a shock to their financial planning.
Steve, that's a crucial point, Janine. We're also seeing a rise in lender switching, with 29% of borrowers choosing to move to a new lender in 2024. This is partly due to changes in the OSFI guidelines, which now allow borrowers to switch lenders without undergoing a stress test.
Janine? Yes, and while that provides more flexibility for borrowers, it also indicates a level of instability within the market as people look for better deals to manage their financial burdens. It's a complex situation, and one that requires careful navigation by both lenders and borrowers.
Steve, and let's not forget about the broader consumer credit trends. Equifax data shows that credit card spending has increased, with a notable rise in delinquency rates, especially among younger Canadians. This suggests that financial pressures are not limited to mortgages alone.
Janine? Absolutely, Steve. It's a challenging time for many Canadians, particularly younger consumers who are struggling to manage credit card payments. It's important for lenders to be cautious and for consumers to seek advice on managing their debt effectively.
Steve. So, Janine, Robert McLister from MortgageLogic.news has highlighted how variable rate mortgages are continuing to attract borrowers, even with the inherent risks involved. It seems the recent Bank of Canada rate cuts are playing a significant role here.
Janine? That's interesting, Steve. With the economic uncertainty we're facing, it's understandable that people are looking for ways to manage their finances more flexibly. Variable rate mortgages can offer that flexibility, but they also bring a level of unpredictability that can be concerning for many.
Steve, right, and it's not just the flexibility. According to McLister, 36% of prime borrowers opted for variable rates last month. The potential for further rate cuts by the Bank of Canada might be enticing more Canadians to consider this option.
Janine, however, the risks shouldn't be ignored. Rising inflation expectations combined with escalating tariffs and a weaker Canadian dollar could lead to higher rates in the future. It's a gamble that borrowers need to be aware of.
Steve, absolutely, Janine. And McLister pointed out that adjustable rate mortgages are currently available at around 3.90% for insured mortgages. This is quite competitive given the current economic climate, but it might not last if inflation pressures mount.
Janine, and on the fixed rate side, there are also good deals due to the market turbulence, with some rates as low as 3.83% for insured loans. But for uninsured borrowers, the rates are higher due to the increased costs lenders face.
Steve, that's a good point. Uninsured borrowers might end up paying 20 to 30 basis points more because of those additional costs. It's crucial for anyone considering a mortgage to weigh these factors carefully and perhaps seek advice from a mortgage expert.
Janine, definitely, Steve. It's all about finding a balance between the immediate benefits of lower rates and the potential long-term implications. Borrowers need to assess their financial situations and decide what level of risk they're comfortable with.
Steve, and as McLister suggests, keeping an eye on inflation trends will be important as they could dictate future rate movements. It's a complex landscape, and staying informed is key.
Janine, agreed, Steve. It's a challenging time, but with the right information and guidance, borrowers can navigate these waters successfully. We'll continue to monitor these developments closely.
Steve, let's delve into the recent news about Canadian household net worth and the associated rise in debt levels. Statistics. Canada reported that household net worth grew by $236.3 billion in the fourth quarter of 2024, pushing total household wealth to $17.5 trillion. This marks the fourth consecutive quarter of growth, adding up to nearly $1.2 trillion over the entire year.
Janine, that's a significant increase, Steve. It's encouraging to see such growth in household wealth, but it's important to consider the underlying factors. While assets are climbing, there's also an increase in household debt, which can create financial vulnerabilities.
Steve, absolutely, Janine. The data shows that household financial assets grew by 2.0% in the fourth quarter, reaching a record high of $10.8 trillion. Domestic equities played a big role here, with the S&P/TSX Composite Index rising 3.0%. A weaker Canadian dollar also contributed to the value of foreign investments.
Janine, it's interesting how different factors come into play, Steve. On the real estate side, the value of residential property increased by 0.6%, recovering from earlier declines. The average resale price rose by $30,000, surpassing $700,000, and home sales jumped by 9.5% in the fourth quarter.
Steve. Yes, and while these gains are impressive, it's crucial to address the rising debt levels. For the first time, Canadian household credit market debt exceeded $3 trillion in the fourth quarter. Mortgage borrowing led the way, climbing to $29 billion as lower rates and improved consumer confidence drove demand.
Janine, that's quite concerning, Steve. Non-mortgage debt, including credit cards and personal loans, also surged, reaching $37.9 billion in 2024. This represents a 31.8% increase in borrowing from the previous year, even though it's still below the levels seen in 2022.
Steve, indeed, Janine. The household debt-to-income ratio edged up to 172.8%, meaning Canadians now owe $1.73 for every dollar of disposable income. However, there's a silver lining as the debt service ratio fell to 14.35%, its lowest since 2020, thanks to declining interest rates.
Janine, it's a mixed picture, Steve. Charles St. Arnaud, chief economist at Alberta Central, noted that while the indebtedness ratio had been improving as income grew faster than debt, household indebtedness remains a significant concern for the Canadian economy.
Steve. That's a valid point, Janine. The household savings rate also dipped to 6.1% in the fourth quarter, down from 7.3% in the third quarter. This suggests that while spending grew by 2.1%, it outpaced the disposable income gains of 1.1%.
Janine, it seems Canadians are spending more, perhaps due to increased consumer confidence. However, investment activity remained strong, with net acquisitions of mutual fund shares hitting $52.6 billion, the highest level since 2021. It's a complex financial landscape, Steve.
Let's dive into the latest data from Statistics Canada, which shows a 3.2% decline in the total value of building permits issued in Canada for January. This drop brings the total to $12.8 billion, and it's primarily driven by a reduction in residential construction plans.
That's quite a significant decrease, Steve. It's interesting to see that residential building permits fell by 3.4% from December, totaling $8.8 billion. This includes a substantial decline in multi-unit housing, such as apartments and townhouses, which fell by $424.2 million.
Yes, Janine. However, there was a bit of good news in the single-family home sector, where permits actually rose by $111.4 million. But Ontario, which had previously been leading residential growth, experienced the sharpest decline in multi-unit permits, dropping by $738.5 million.
It's a mixed bag, Steve. While Ontario saw a decline, Quebec and New Brunswick experienced increases in permit values. Quebec's growth was particularly notable, with a $186.3 million rise, largely driven by a $160.2 million surge in the Montreal area's multi-unit permits.
On the non-residential side, there was a 2.7% drop in permit values, marking the fourth consecutive monthly decline, bringing the total to $4 billion. Industrial permits took the biggest hit, falling by $285 million, followed by a decrease in public sector building permits.
That's right, Steve. But it's not all declines. Commercial permits actually rose by $259.4 million, which is a positive sign amid the other decreases. It's important to remember that despite these monthly drops, the permit values in constant dollar terms are still 13.4% higher compared to January 2024.
It's a complex picture, Janine. While there are areas of growth, the overall downward trend in building permits could have implications for the housing market and broader economic activity. We'll need to keep an eye on how these numbers evolve in the coming months. Now let's turn our attention to a crucial topic that's been gaining traction: living paycheck to paycheck. It's a situation that many Canadians find themselves in, regardless of their income level. Michelle Zadikian from the Canadian Press highlights that this isn't just an issue for low-income earners. In fact, it can affect anyone across the income spectrum.
That's right, Steve. Cindy Marcus, a certified financial planner at Open Access LLT, points out that even high-income earners can fall into this cycle. Sometimes, as people earn more, their lifestyle expenses increase accordingly, leaving them without any significant savings or debt repayment progress. It's a reminder that financial habits are crucial, no matter how much you earn.
Exactly, Janine. To break free from this cycle, it's essential to identify the root cause of the issue. Doris Asiedu, a credit counselor with Credit Canada, suggests laying out all the numbers to understand where your money is going each month. This process can reveal spending patterns that might need adjusting.
And once you've got a clear picture, there are several strategies to consider. Increasing income, whether through a raise, a job change, or additional work, is one approach. On the other side, cutting unnecessary expenses is crucial. Asiedu emphasizes the importance of tracking variable costs like takeout lunches or ride shares, which can add up quickly.
It's about more than just cutting costs, though. Marquez categorizes spending into non-negotiable living expenses, savings and debt repayment, and discretionary spending. She advises against sticking to rigid percentages, as everyone's situation is unique. It's more about how spending aligns with your financial goals and lifestyle.
Absolutely, Steve. Marcus suggests that visual tools like fundraising-style thermometers can help people see their progress towards financial goals. It's about creating motivation by showing what could be achieved by changing spending habits, whether it's a larger savings account or a more comfortable retirement.
Staying on track is key, and Marcus recommends having a slush fund for unexpected costs, as spending needs can vary by season. Banking apps can be helpful here, with features that automatically save spare change or transfer funds to separate accounts.
Doris Asiedu reminds us that setting realistic, measurable goals is crucial to avoiding setbacks. It's about making sure your financial plan aligns with your priorities and sticking to it until it becomes second nature. It's a commitment to long-term financial health.
It's all about taking control of your financial future. By understanding your spending patterns and making informed decisions, breaking the paycheck-to-paycheck cycle is possible. It's not just about cutting back, but about making smarter choices with your money. Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder, Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time, and stay informed with the latest industry insights.